Have you ever wondered who's really pulling the strings behind the interest rates and inflation? The answer is none other than today's star of the show, Federal Reserve. In March 2020, the Federal Reserve injected $700 billion into the economy, an amount comparable to the entire annual federal education budget. But how does the Fed impact your money? From mortgage rates to economic stability, understanding the Fed helps you make smarter financial choices. Before the Fed's creation in 1913, the U.S. faced financial panics nearly every 7 years. The Panic of 1907 alone saw the stock market drop nearly 50%, leading to numerous bank failures. Therefore, Congress established the Fed to ensure price stability, maximum employment, moderate long-term interest rates. Since then, major banking crises have become less frequent, recessions have shortened, and bank failures have significantly declined. The Fed operates independently within the government, comprising a 7-member board of governors, 12 regional banks, the Federal Open Market Committee, FOMC. It supervises thousands of banks and bank holding companies, overseeing $23 trillion in assets. Fed officials serve fixed terms to prevent political influence. This independence allows tough decisions, like when inflation hit 14.8% in 1980, the Fed raised interest rates to 20%, curbing inflation, but triggering a recession. The Fed manages the economy through 3 key tools. First is federal funds rate. It's like the interest rate your bank charges you, but for commercial banks borrowing from each other overnight. Changes here ripple out to affect all other interest rates. It was near 0% in 2008. Raised to 5.5% in 2025, mortgage rates more than doubled from around 3% to over 7%. Second is reserve requirements. Think of it as a safety net. The minimum cash banks must keep on hand. Lowering it frees up money for loans. For example, the Fed reduced reserve requirements to 0 in 2020 to boost lending during the COVID-19 crisis. Third is open market operations. When the Fed buys or sells government securities, it's adjusting the amount of money in the economy, much like controlling the flow of water from a tap. During the 2008 crisis, the Fed injected over $1.7 trillion into the economy via government securities purchases to stimulate growth. While in 2022, it started withdrawing up to $95 billion monthly to combat inflation. These tools directly impact lending, spending, and economic growth. How do Fed policies affect you? Housing market. Rate hikes added nearly $1,000 per month to a $400,000 mortgage. Housing affordability hit record lows, consumer credit. Credit card rates jumped from around 16% in early 2022 to over 20% in 2023. Auto loan rates rose from around 4% to over 6%. Employment. Unemployment peaked at 14.7% in April 2020, then dropped to 3.7% by December 2023. These numbers shape everyday financial decisions. Today's Federal Reserve faces complex challenges that will shape the future of the economy. Inflation control is at the forefront, with the Fed striving to bring inflation back to its 2% target amidst economic uncertainties. Digital innovation is transforming finance. The Fed launched the FedNow service in July 2023 for instant payments and is exploring a potential digital dollar to keep pace with technological advancements. Global dynamics complicate policy decisions as international tensions and shifting trade relationships impact the U.S. economy. Additionally, climate risk is now a key consideration, with the Fed assessing how climate change affects financial stability. Balancing these factors, the Fed's decisions today will define the financial system of tomorrow. The Federal Reserve's policies affect your savings, loans, and investments. By understanding their actions, you can make better financial choices. If you found this video valuable, subscribe for more insights into the economy, finance, and technology.